some of the lessons I've learned, I started back in '83, and that first call was to Buffett, actually in '82. And so what kind of the things I've learned, you really have to be tenacious on your research effort and again, seek out truth in the operating reality and continue to focus on that, which is what we've done. So, um, and it's been fortunately, that's paid off for us as far as over the long run. We always say, we're looking for, businesses with a heart and soul, and companies that we can buy those leaders at the right price. And I was just looking at some of these in the portfolio. We started, the fund in '99, top of the market, and the equity portion is actually doubled the S&P. It hasn't been fully invested because it's more pretty conservative fund, but I think the equities are up about 1,300 versus the market of up about 650. So we do have a record. Then we have an audited record back to '89. So we've seen a lot. Um, but kind of the lesson I've learned is again the tenacious research, and then there's so many companies we've missed over the years, and but we've hit on a few of them that again, like on Philip Morris, when I first called Buffett and he had all these tobacco stocks, I couldn't believe it, because they're on the West Coast, joggers and everything. And we ended up, those positions we bought, like in Philip Morris, are up 100-fold, and the dividend on a $1.50 basis, the dividend's like 5.5. So, that's why, the investing kind of the craft of the specific, you really got to know your businesses, because I don't think there's been a year since we've held that company where the news has been good. But that's the thing, going through these businesses and just meeting these managements. We had a company called Lincoln Educational, and Scott was in our office, a founder. Scott Shaw, like 4 years ago, stock had dropped all the way down to two. Well, they train electricians and skilled labor, and so we really liked the management balance sheet, and so that stock. So then he came back this year, stock's 24 up from two. So the moral of the story is really work hard, try to find these great managers. If you can buy them, like Rodney Sachs, another one. He was one of the early founders of Monster Beverage. Well, since he took over, I think it was in 1990. Actually, since '94, the stock is up over 200,000%. Number one performing stock of all stocks, and 10,000 grew to like 20 million. But it's just the moral of the story is you really have to work hard, find these great businesses, find these great managers, and you really got to ride with them.
Well, absolutely. And there are obviously ups and downs in that journey. That's why it's so difficult to stick with them for most investors. You've managed to do that. Um, and I think in the last year, we've seen some of the quality businesses, the compounders, again, be somewhat challenged in the market. And I'm wondering your thoughts on that and whether anything is changing that's fundamental in your view, or whether it's just another cycle like what you've seen so many times in the past.
Yeah, I think again it gets down to those fundamentals. Ironically, I'm just looking at some of these returns. Where you've had things like Bank of New York up over 50%, and Philip Morris, all these. There's been some tremendous winners, Alphabet, but you've had to do the homework. You've had to be really tight on your fundamentals generally, and so. But there's been a lot of high quality that goes out of favor with. We've had a huge speculation. We have triple, and actually these ETFs are 5 time levered, and your margin debt, has climbed. I think it's as of last reading up, 40% or more year over year. So when you're in a speculative, no revenue type environment, the quality tends to really fall off. So we've kind of seen that in a lot of industries like, healthcare, although healthcare kind of roared back. But again, it's a matter of you know, really assessing the strengths of these businesses and looking at the disruption. So we spend all day long, studying the business model, studying the management, capital allocation. So it's really been just like you look at, we have a lot of Alphabet we bought years ago, and but that they have really executed. So that's been one of the top performers because of that execution, despite, you know, um, but same thing now with the transition of the tobacco into the nicotine products, and now they're using nicotine for Parkinson's, and you've got Kennedy using Zen pouches and what have you. So and that's a case. We had a company, British American Tobacco, is up, I think almost 60% this last year. Starting with a 7% yield. So again, it's been one of those years, and it's not going to change where you've got a lot of passive flows, and so you've got a lot of investments that's not made on price and value. But then, if you can find these great managers that can, like I mentioned, the Lincoln, and that stock was up 52% and this year, but it's actually gone up from 2 to 25 the last, or 24 the last 4 years. So, um, that's kind of the again, there's just no shortcuts. It just reminds me of like Tom Brady and something, Kobe Bryant. They're just you have to keep outworking everyone and to protect. But there's just a lot of speculation. People don't know. They're buying these no revenue, or the companies with no earnings revenues, and you had a lot of central banks buying up gold, and so there's been a huge gold move in gold, and then probably the last 30% has been the speculators. So, but it's been a real speculative market for half the year, and which is hard because clients in general, everyone's envious and they tend to get greedy. But but again, I think our focus is on growing operating cash flows, and buying right, making it on the buy side.
Absolutely. And there are definitely still some good pockets of value to be had. We recently hosted our Latticework New York event, and we had folks talking about some quality businesses in the chemicals sector, for example, which's been not so great lately. Where are you seeing value, or what pockets of the market or specific businesses do you feel like are truly undervalued today?
Yeah, again, I go through about maybe 1,800 companies one by one, John, and excuse me, and so again, it's a case by case. We had a real interesting company called Fiserv, and we just started to nibble at it. It had dropped down to in the 120s, and the stock was like 12 times earnings, and they had bought First Data, and this is a company that for 30, I think 38 or 39 years has had double-digit earnings growth for like, and then I don't know if you know the story, but they missed. They were supposed to grow double digit, and they dropped the growth to like 4%. Stock dropped 40%. So this is a company that was 91 times earnings back in 2000, during COVID. It was 91. The average PE has been over 30 the last, 10 years. Now they're even on depressed earnings, maybe 860 this next year. I mean, they're down to like 7 or 8 times earnings. So that these markets can just, um, but now, I mean, it's got I think a double-digit free cash flow yield as well. New management, but this is a company, it does back office processing. It shouldn't go down. That just shows how much risk is in the market, you know. That was supposed to be, you know, a 10, 12% grower that now is maybe a 4% grower. And with that decline, it dropped 40. So, you know, there's been a lot of those like Deckers, which is at a great, terrific track record, debt free. And I mean, it got clobbered. So a lot of those, you know, opportunities. Again, Amazon was down, you know, 215, and we were adding to that when it was flat, you know. But you know, so it's really a matter of tracking these companies. We tend to try to buy when they have fixable problems. We think Fiserv is very fixable and really good new management team, but and then buy when you can get the double, triple play, you know. So those are, um, but we're you know we're finding, like I say, you know, the average stock will fluctuate 50% every year. So you know if you know what you own and you can um, no, fortunately, we've owned so many companies. Like in our fund, I can tell you every single fund every single stock we've bought, and all of the circumstances. But again, you know, like Buffett says, the market's there to serve you, not guide you. You know, and you apply that tenacious research, and then if you're rational and you just wait, these opportunities, they do come along. And we just try to be up on the research on these companies, and then typically we're waiting, you know, for a mistake, you know. But it right now there, I've never seen so much speculation. You know, most like our fund, I have 100% of my retirement locked into that fund. You know, I can't sell it. But most funds, you know, half the fund managers don't have any investment. And most of the ETFs, there's no ownership. There's no skin in the game, you know. So all this violates the basic, you know, the old Henry Singleton tenets, you know, all these terms of buying right and you know, capital allocation. It's just but longer term, that does matter. It's just in the short term, you've got a lot of speculators in there that, like I say, with the leveraged ETFs. But that does create the opportunity when that leverage unwinds. You know, that's where we wait for that leverage, you know, point to unwind.
And so, how do you decide what kind of a cash position to have as sort of an option on that kind of an unwind and then all kinds of bargains appearing?
Yeah, so we have a lot of T-bills. Like the way Buffett holds T-bills. The bond market hasn't, we can't think we're in a long-term bear market in bonds, but so we hold, you know, a lot in reserve. It's kind of the same like Jim Rogers says, you know, like we just keep it in cash. And then when the great deal comes along, you know, we make the bets. Now we, unfortunately, we don't have the luxury to make those concentrated bets because of the clients profile we deal with. Far more conservative, but you know we're looking every single day, and you know a dollar is funny. I was looking back over 100 years. A dollar invested in the U.S. dollar dropped to like 3 cents. A dollar in the tobacco industry grew to 6.2 million. Like $1 grew to 6.2 million versus a dollar to 3 cents, you know. So you want to be in good businesses, but you have to buy them, you know, to get the double, triple play. So our margin of safety is making a great buy and getting the double, triple play. But so we, you know, cash, unfortunately, I mean, normally, I mean, back in 08, 09, I mean, we bought 35. The spreads blew out from like 3 to 4% on these corporates to 21. But right now the spreads are so tight there. I mean, it's tough. You kind of have to leave it in treasuries and then wait for accidents. You know, like the Fiserv that stock. I think at one point it was at 200 down to 60. And so you have those kind of blowups, and usually when they start making jokes about the company, that's the time you want to. Years ago, we had 9 nuclear plants, and they 8 of the 9 failed and they became known as whoops, you know. And there was always the jokes. Well, the number two was rock solid. This one out of the 9 was rock solid. So we were buying these 8% munis at 48 cents on the dollar. It's funny. Then come to find out Buffett was buying the same bond, but that those went from 48 cents on the dollar to 150, and they were paying an 8% coupon. But there was just a running joke because these companies all came out AAA rated by S&P and I mean, on the prospectuses, and so that's why you have to be ready to buy when the headlines are negative, but if the fundamentals are there or if it's temporary, and so that's why I would think now with all the leverage, all the margin, and all the ETFs, there's going to be wild swings. I mean, when you've got the president, promoting cryptocurrencies and that and you look at the top 50 developers in China, which are basically all insolvent, and that mentality can definitely get you into troubles. But the flip side, we do better on the backside. Our best numbers were 99 through 2009, when that whole thing blew up. I think our fund was in the 1 percentile in '02. So this approach does better in the bad, so we're kind of hoping for the bad times.
Right. And just looking at the 52-week low list today, I see quite a few quality names actually kind of in a similar sector. I see Procter and Gamble, Mondelez, Diageo, Kraft Heinz, General Mills, Brown Forman. Are those the kinds of businesses that you'd be interested in, that you th would consider as durable?
Yeah, no, we've been in fact, back in '82, the only stock that didn't move, we had this real strong move in the market from '82 to '83. And Brown Forman had bought Lennox China and it crushed the stock. So it dropped it to 7 times. So we bought that. It went from 7 times all the way to 45 times. So, and we followed, we do have some Diageo but the the problem with the alcohol, and we look at all those Molson Coors, we do have some of that in Diageo, but the drinking rates are at what, 90-year lows. I mean, and they're now coming out. It used to be, well, you could have a glass of wine every night. Now it's like no alcohol. I mean, you can't drink anything. So we went from COVID where everyone was sitting at home, chugging down, having two or three drinks a night or whatever, to we've gone the other side. So those cash flows are so good, like Molson's and Diageo. I would guess they would go private. I mean, the values are really compelling. It's just the fundamentals are so bad, and the same with the GLP-1 drugs, and same with Kraft Heinz has been a disaster since Buffett went he was in part of that merger with Kraft and Heinz back in, was it 2015, I think. And so we've watched that. We originally had, like I say, I think those stocks from our early 1982, 83 Philip Morris buy. But yeah, the fundamentals are just tough. And we've learned, you've got to have earnings drive stocks. And so they are down, they are cheap. And I think with a lot of the M&A, I think you'll see some mergers. You saw Mars step in, and Mondelez. The problem is these GLP-1 drugs. Like the snacking's way down, the drinking's way down. We need another COVID pandemic to bring all that back, but. So we don't see the compelling. The only thing that we bought aggressively when on the drop about 18 months ago, like Philip Morris, British American Tobacco, they're like British American Tobacco was like $30, like 7% yield, 7 times. But this whole movement toward the nicotine patches and just taking straight nicotine, not the tobacco. But we look at all those stocks, but they're just the fundamentals. The only way I see out on there is a merger trends, and so we're pretty sensitive to to the current fundamentals. And if earnings are like Pepsi 4% yield, those are and that's where you're seeing the best yields, in those kind of companies. But they're, like I say, we don't really see much. The fundamentals are still kind of pretty weak.
And I'm wondering whether you would agree that maybe there's also bifurcation between the hard liquor companies and the brewers, because the brewers are coming out with alcohol-free beer, and that's maybe an alternative that's gaining traction. But if you're in hard liquor, you're not going to have an alcohol-free Jack Daniels, right?
Right, yeah. It's amazing. Like, yeah, I was in Mexico visiting all these tequila. There's a town down in Mexico. They do most of the tequila, and they've been around for like hundreds of years, literally. I mean, I think 200 years, but um, yeah, it's the problem is you've had with the legalization of marijuana, and you've had a lot of other alternatives, and so the beer has been flattened out. Now everyone's you go to a construction site, it's zen. They like the caffeine or the nicotine and the caffeine. Those are still doing well, but as far as alcohol, the spirits, I guess people are drinking, instead of having two drinks, they're having one, or and then the GLP-1 phenomena. So, and they're just, so we're watching it. We do watch for the turn. We just haven't seen the turn, So we're less inclined to just buy unless we see that turn.
Yeah, and then in healthcare, I mean, you just mentioned GLP-1s, and you have Novo Nordisk, which has come down a ton. And we've had someone argue recently that you're getting their entire pipeline for free, basically, at the recent price. Do you look at healthcare giants and try to value their portfolios and pipelines as well?
Yeah, that's another really tricky area, because I don't know. I think a lot of these drugs, we haven't seen the side effects, because those weight loss drugs, they take your protein down and your muscle mass, and like there's like I think 91 million people on statins. Well, the statins, the cholesterol reducing drugs, and every doctor, they want to put it in the water supply or wherever, but and that's I think 30 to 40 billion is made on that, but most of your brain, John, is cholesterol, and when you reduce the cholesterol, in your heart and your brain, well, that story Ronald Reagan said, well, President Reagan, you're on these statins. This is 1985, I think, or 86. He goes, yeah, tell us about it. We go, well, there's three problems. Like the first one is you lose your memory, and he said, I forgot the other two. Well, they dropped his cholesterol down from like 220 to like I think it was down to 110. And then he got full-blown Alzheimer's. And, so to me, and I've had friends, same thing where I had one friend, he was actually head of a major research organization, and he's real disciplined. He never wanted his cholesterol over 115. So anyway, he dropped his, kept it to 115, full-blown Alzheimer's in his early 70s. So anyway, I've been studying these GLP-1s. I think there's going to be problems with those, and that's why you kind of have to look through and say, I don't know, I mean, that's just a personal, um, but Novo does look really interesting, on evaluation. It's just watching, Pfizer and some of these where they've been, Pfizer has it literally, I think back in '99 they had their big, uh, the big, their big drug that um, the blue pill came out. But that stock hasn't gone anywhere since 1999, like 25 years. So that's why those are, and Lilly has done phenomenally well. It's just, you can just get, like what happened to Merck, and you saw what happened with China, and they cut back on their drugs, and who knows, they're pricing these, and it should work, but everyone's, we're so accountable for each pick that to quantify the downside is really hard for me on those.
Absolutely. And I'm looking here at Nike as well, down 55% over the last 5 years and even more from its highs. Um, do you feel like a company like that is, going to continue compounding? Would it be an attractive idea to look at potentially?
Yeah, we have some really low basis Nike over years ago, and the problem is the valuation was so high for so many years we didn't really add to it, and then the valuation is still really high. And again, I remember way back, Phil Knight would try to retire, and the stock would get killed because the new replacement just he had to come back like I think two or three times, and I don't know. We bought some Deckers. It dropped down to like 85, I think, and it was got clobbered, but debt free. But Deckers like 13 times, or I'd rather buy a Fiserv at 8 times, with a problem versus, as I recall, Nike's still pretty highly valued, right? I mean, I haven't looked recently, but um, we'd rather be tighter on our fundamentals, like we'd rather have that strong earnings at a low valuation, to get the double. I'm looking at like at our bank in New York, that thing was dirt cheap. And then I think this last year we're up 50% on that, but just kept plodding along, and you had multiple expansion. And we talk about the torpedoes in the portfolio, high expectation, high valuation, and when they compress, if PEs compress. If Nike was like 12 times earnings, I'd be interested. But um, you look at the valuations, like we look all over the world, and you look at like an Alibaba or Baidu, and those tech companies are 1/10 of the value of our tech companies. And you just at some point, just like the alcohol companies, or just like Fiserv was 91 times during COVID. And those alcohol companies during COVID and all those snack companies were historic highs. And then you see what's happened. So um, we'd rather be tighter, in buying lower valuation with improving fundamentals versus like we're looking at like Zimmer, yeah, as an example. So really low valuation. They do hips and knees. Well, you got, the growth in pickleball is like 300% the last 4 years. Like 48 million people have played pickleball the last year. And I mean, hips and knees, and now they're doing shoulders. And that stock is, trading at 12 times earnings. And normally, the most of those med techs are like 20 plus, right? But that's what we're looking at. And also just like Latin America, you're seeing with people, look at Venezuela. Venezuela like was one of the top four economies in 1970. And Venezuela has like 31 million, I think, people, and a GDP of like, I think it's 82 billion or 92 billion. Well, California has 39 million people with is it 4 trillion um, in terms of their GDP. And so you look at, so we have a company called Arcos Dorados, and they're the number one McDonald's franchisee in Latin America, right? Well, they're really big in Argentina and fairly big in Venezuela. Well, the first thing you're going to do when you have some more money, like you're going to go to McDonald's, right? So I mean that's a stock that's like 10 times earnings, but so we'd rather play those at 10 times. We have a company called Walmart de Mexico, used to be Cifra. Well, we bought that during 93, 4 when Mexico's peso got crushed. And it's up like, I think 17 fold. But, you buy those kind of businesses at low valuations. But Nike, back to your questions, is like, yeah, at 10 to 12. We always like to, historically in my careers, buy them at, 10, 12, and like back 1983, Waste Management was growing at 16%, 9 times earnings. So it went from 9 to 40. So in 5 years, we sold it at 40 multiple. But Nike to me is kind of like, it's great company. It's just, you know, too highly valued here, for me anyway.
And I'm curious when you have a company like Walmart de Mexico and trading at a reasonable valuation, and then you have something like Costco go to 50 times earnings or something. Do you reallocate or rebalance? How do you do that? Because obviously you've been successful in holding the winners over the long term, but at some point maybe they get a little rich.
Yeah, no, we actually, fortunately, the firm I was with, we helped Jim Sinegal get that funding for the original seed money for Costco. So we have some Costco at 18 cents, but the mistake over the years on Costco has been me selling. But it does, it's like this last year was 50, and so we did peel some off last year. Well, when it got to like 50, I remember in 98, 99 at the Berkshire meeting in Buffett, Coke was at 50 times, and people were like, why are you going to buy Coke? He says, well, maybe at 40 times. But Coke, if you look at Coke, now the other flip side is Monster. If your numbers are there to support 50 times, like Monster has never been cheap. And $10,000, like we talked about, 94 is worth 20 million. Well, if you have excellent top and bottom line growth, you can hold those, and Costco's been phenomenal. But at 50, I mean, there's just too much competition. I mean, you got Amazon delivery, and now Aldi's coming in, Aldi's just really tough. And we have some Kroger, which has been really cheap, but it hasn't gone anywhere. But yeah, no, generally, if they get to, 40, 50, we systematically peel those back. Years ago we had Nokia. We bought it before it was a phone company. Our basis was two, and then the tech telecom media bubble hit. So it ran to 40, and then from 40 to 50, we probably sold it, I don't know, 12 times, and then it dropped all the way back to eight, and Microsoft bought it at eight, and then they wrote it off in 9 months. So so but generally, if you're in a bubble, back in the telecom bubble, where what happened back then, everyone was saying, oh, this is doubling every 2 or 3 months, so all the telecom companies just loaded up on fiber, and we just kept, and then all of a sudden they said, oh no, it's not doubling it's maybe doubling annually. So all of that investment, like level three. I remember I was interviewed by the Omaha World Herald, and level three was like 175. And they asked me, they said, what do you think? I said, there's a lot of supply. I don't know where that's going to end. So the next Berkshire meeting, the next year, the stock was five, and here's level three with Peter Kiewit, and, the smartest people in the world were in this thing. And that's what's happening now. Like, that's why on these cells, when they get to that valuation, we have kind of a rule. If we're in a bubble, we can ride it, but you gotta just get on a regular scale out, because I've seen too many in my lifetime, as in yours, in generally, if you look at go back 200 years, you usually have, five really strong years on the back of technology. Like 1920s, you had radio, RCA, most widely held company. Everyone owned it. It was like, and it went drive up to 102, then it went from 102 to two, but you had back then, airlines, and everyone was borrowing for, electricity, cars, airplanes, all that. And then you'll have these periods where you'll have like 5 to 8 good years, and you'll have 16, really tough years, So I think we've got about a year or two left, and then we're going to be in our kind of a market where it's just flat. doesn't go anywhere. And like I say, from 99 through 2009, we way outperformed because you really had to know your companies. It's like when Buffett, like 68 to 81. I mean, though 82. I mean, the Dow is what 1964 was 1,000. By 1982, like when I started, it was 888. And that's a long period. So that kind of the moral of the story is you have to know your companies, you have to buy them right, and you don't know when this whole bubble will burst. But if you're not on all the other companies, that's why I go through 1,700 companies to 2,000 companies a year, because we want to know when we want to know fundamentals because when it breaks, but I remember 99, it was like all the value, like small cap value at 98 was down like 40%. And Buffett was down in 99 and the market was up and everyone was just hammering them because, here's Berkshire down and people are going like, well, my account went up like 100% and you were down, and then it broke real fast. So that's kind of what we're in. I think we've got another year or two, but then this thing is gonna be so over, just like we over, AT&T, all the global telecoms, they overbid for spectrum, overborrowed, like shale back in 2012. The marijuana companies, we worked for 6 years on those things and never bought them because, they way over invested. And, like so anyway, that just like look at China. I mean, that real estate market's still going down in the top 50 developers. So when money's easy and people just are exuberant, there at some point we're up the escalator, down the elevator. We don't know when, and so that's what we've always fished in ponds where there's no capital. Nobody likes tobacco. Nobody likes like the health insurers. Everyone hates those now, but I mean, there's no capital going in there. So we like those versus when everybody is. I just remember tech telecom media, everyone, we deregulated telecom in 98. And that was the end of telecom because, we had this one company. I was with eBay. I was with a company with Benchmark. We went on the Series A in this company called the eBags. And so Bob Cagle did the eBay. It went from 5 million to 5 billion. And then they go, what's your next best idea? eBay. So we fortunately were in that first round, like at a buck, senior and everything. So we thought, oh, we're gonna kill it. Well, it was like 15 years later. I mean, we had a buyout offer for 10 to 1 real quick, but then Benchmark didn't want to do it. So that thing was the hardest. But the point is like um, when these bubbles burst, when money's easy, it'll dry up. And I just remember like Bear Stearns talking to them, and they were funding back in '07, everything 100%. They were funding on the commercial paper. I go like, aren't you worried? Like what happens if they stop funding? Oh, that hasn't happened in 100 years, and then boom, the money shuts off. So anyway, those are lessons I've learned. Like. That you really have to do your homework every day. And like this Electronic Arts, this $50 billion deal at almost 30 times, I think 28 times operating cash flow. Well, the one in Texas Utilities, that was 45 billion. This is 50 billion. Texas Utilities in '08, they did that at 8 times operating cash flow, right? And that one went bankrupt, Buffett was in that one too. And this one's at 50. And so at some point, this whole thing, this private equity and a lot of that is going to come unwinding. We don't know. We just saw the first, inklings of that, with some of the auto players. And but anyway, those are sorry to get off track there.
Not at all. Thank you for that perspective. Um, Jeff, I'm wondering if you have a take on Becton Dickinson. That one still looks attractive from a valuation standpoint. It dropped earlier around May or so and has come back a bit, but it still seems to have quite a lot of upside if fundamentals can improve.
Yeah, that's another one. You'd think, Becton, most of what they do is, a lot of, needles, lot of the basics in hospitals, and their growth rate slowed way down, and they got they got hammered. So that was another one where you had a low valuation, and then the fundamentals for the business slowed, and as with a lot of the healthcare names. And but yeah, it's we're looking for like a re-acceleration if you're looking for any kind of a pulse because the valuations are so low on that. And it doesn't take much. So we're aggressively monitoring it. We did buy when it dropped. But a lot of these companies, kind of like Zimmer's the same way, it got clobbered. And you'd think hips and knees and the peak hips and knees are like 67 years. That's kind of where the baby boomers are. And yet that stock dropped to a 12 multiple. But I think the quality, that's one thing. Like you look at what happened to Merck and Becton Dickinson, but Becton is kind of like a necessity type business, for most of their lines, you think. But it's been a lot, there's a lot of pressure on hospitals, to cut costs. So that whole healthcare area um, really got hit, and so we're kind of like we check and the fundamentals are ticking up. We're there, but it's slowly improving. Um, but that the whole headline with the healthcare headlines and with Trump going aggressively on that. It's just kind of like United Health and Elevance and Cigna. I mean, they've just been hammered, and these companies have just tremendous free cash flow. Um, but that's what's amazing to me. Like you look at these high valuation companies, 30, 40 times earnings, and like you look at these companies that were like low. I go back to the Fiserv, that was at 12 times earnings, and it dropped at 8 times earnings. And so like if you go from like 40 times down to 15. This whole market has so much risk on those, because if you just miss a little bit, they don't take you down like 5 or 10, they take